Good afternoon, all, and welcome to our third and last webinar in our trio of webinars ran by TAMIM this month. Our focus today will be on the Australian equities. My name is Ben Narcis. I'm the Director of Distribution here at TAMIM, and I'm joined today with Australian Equities Portfolio Manager Ron Shamgar and Darren Katz, TAMIM co-founder and Head of Investments. Many of you already had the opportunity to have a chat with over the phone, so wanted to thank you for that. And for those who I didn't have the opportunity yet, I hope I will soon. When on the phone, lots of people trying to guess where my accent is. So very quick background. I was born in Belgium, lived in 8 different countries, speak 5 different languages. My last stop was here, Sydney, 4 years ago. You know what they say, it's all about the journey. I want to thank everyone for taking the time today to join us for this webinar. Enough about me. Our plan today is to run the webinar for approximately 40 to 45 minutes, leaving us 15 minutes for the Q&A. If you check at the bottom of your screen, there should be a space allowing you to raise questions during Ron's presentation. Ron would be more than happy to address them at the end. Also be aware that the webinar is being recorded and we will send the recordings in the next few days. Disclaimer, we put this at the beginning of each of our webinars, just as a reminder that this is not specific advice to you, but rather just general advice only. For those who are not fully aware of TAMIM Asset Management, let me give you a quick introduction. TAMIM is a boutique investment management firm. We manage just over $228 million on behalf of around 520 clients. We focus on our endeavors in generating returns to our investors. We tend to look on generating those returns in a slight differential manner to everything else you have in your current portfolio, and they're giving you some good diversification. We focus on 3 different classes, being equities, property, and credit. Within those asset classes, and specifically on the equity side, we focus on Australian investment solution and global investment solution. And within the Australian solution, we have 2 solutions, being the small cap and all cap, managed by Ron Shamgar, and the main reason why you're all here today. On our global equity, we have our global high conviction, which is managed by Robert Swift. Robert has been generating a 13.10 annualized return since inception. Our mobility fund is run with Ryan Mayon. Ryan is a partner at Ibex Mobility Equity, which are running the mobility fund with TAMIM. The fund focuses on sharing, autonomous, and electrification. These 3 pillars are the building blocks for the future of mobility construction, $7 to $10 trillion revolutions. Next fund would be our property fund. Within our property side, we tend to invest in single assets. I like to tell our investor that we like to purchase assets that other people are running away from. Going back 5 years ago, when we were buying shopping centers, people were telling us we were crazy and if we ever heard of the online shopping and the internet. Then there was our office building we purchased in Adelaide. I think then it was, have you not seen that people are working from home? Overall, we believe in change, but strangely enough, we always go back to being the same. We currently tend to focus on office opportunities, but opportunities where we believe we can get those buildings fully leased, and I'm glad to say that we have been quite successful doing so. Finally, our last asset class would be the credit fund. We run this portfolio which invests in private debt investment solutions. Fund has done exceptionally well with only 1 negative month since inception in 2018, paying this last quarter a record 2.13 cents and looking to generate on a forward basis over the forthcoming 12 months around 8.5% yield to the investors net of fees. Just as a reminder, we ran earlier this month both our global equity and mobility fund webinar. So if anyone is interested in the recordings of those webinars, please let us know in the Q&A. With that, I will pass control to Ron and Darren. Welcome, Ron. Looking forward to what you have to say today.
Thank you. Thank you. And
Hi, everyone. I've got Ron sitting next to me, but his microphone is currently on mute.
Can you hear me now?
You're there.
Thanks. Okay, so just go back slide. Good afternoon, everyone. Sorry for this little technical difficulty. Okay, so today I'm going to talk about just a quick overview of the big picture of sort of what we're seeing, where we think markets are going, where sentiment lies. But we're not going to spend too much on it. We will talk more about the different stocks in the portfolios that we hold, why we're really bullish, and then obviously we'll take questions. Just for everyone that don't know, I run two strategies for TAMIM, the old cap portfolios and the small cap income fund as well. So, the last time I did a webinar and spoke to everyone was sort of beginning of April. We were coming out of that terrible bear market of 2022. Everyone was super bearish, and I was, trying to convey the message at the time that, it's time to be greedy when everyone is bearish. And even after, the last 5 months since then, where, the markets have sort of recovered, sentiment has changed a little bit. Sentiment is still relatively bearish at the moment. And I want to illustrate that with some of these charts below, which show where, current cash positions of investors and where sentiment lies. And as you can see, there's still record cash levels sitting there. The July Bank of America Fund Manager Survey on the right side shows that, the most crowded trade at the moment is still cash, and equities is still the least crowded trade. It still shows a level of pessimism at multi-year lows. And if you look at the chart on the left, it kind of gives you an idea in terms of the last sort of 25 years. And as you can see, even though we bounced off the 2022 sentiment lows there on the right side of the chart, we're still way, way, way below what would be called sort of a top of the market or sort of a bull market as well. So I think a lot of bad news is still priced here. And you got to remember that we still, you need bulls for a bull market, and we don't have that yet. So just putting everything in perspective, I think it's really important. I really like this slide, which I put back in April as well. And it shows the average bear market over the last, 60, 70 years, defined by a 20% drawdown or more, lasts for around 15 months on average. And in contrast to that, bull markets tend to last for many, many years. Now, the last year's bear market, we don't know for sure because no one rings the bell, but it probably ended about 6 months ago. And it usually lasts for about 15 months or 17 months or so. And I think that's sort of what that one, the last bear market lasted. Now, we don't know where you're in a bull market until a year or two from now, because you actually have to see the market continuing to go up. But we believe we're at the start of a new bull market. And I think it's really important to remain invested because if you miss those first 10 days after the lows of a bear market, your returns are significantly lower. And I think one more thing that gives me quite bullish sentiment is the chart on the right, which is the volatility index, is indicating the market conditions are normalizing. So as you can imagine, when investors are nervous, when they're concerned, for example, during the COVID time, you can see that big spike. And last year, the VIX was elevated. That's when markets tend to sell off. And when VIX comes back down, actually today the VIX is around 13 or 14 times, so it's even lower than that chart. Shows that investors are less concerned about things that they don't know about. And when market conditions normalize, that's when fundamentals come back into light. And that's where we tend to do really well, because we are good at picking companies and stocks rather than predicting markets. So I think now that the market conditions are normalizing, you'll see really strong returns for both portfolio strategies. And we obviously the two funds that we invest, we can buy small caps, mid caps, large caps, but we do think that the best opportunities in the Australian market lie in that sort of small to mid end of the market. And we do have a bias towards small and mid caps. And if you look at the current valuation, the ASX 200 index is now on a 12-month forward PE multiple of around 14.5 times versus its 5-year average of 16.5 times. So we're sort of trading at around that fair value. It's not cheap, and it's not expensive. And to put that in perspective, you got to remember when the market is really cheap, it usually means there's bad things going on. The markets are selling off. So you don't necessarily want that. And obviously when the market is super expensive, we're probably at the top of the market. So this is now a level where we believe is the start of the next bull market, and valuations are fair. And if you pick the right businesses, we're going to do really well over the next few years. The problem is that in the Australian market, the small caps are trading at a big discount to their larger peers. The small odds index on a forward multiple of 13 times, and it's trading below its long-term average PE. And if you look at the chart on the right, the small ordinaries index is still a large discount to its larger peers, around a 17% discount at the moment. It's up a little bit from that chart. And if you believe that small caps have a greater potential for growth than the larger caps, which we do, then I think there's a really good opportunity for small caps to outperform as sentiment starts to improve. And I think you'll see that over the next few months and the next couple of years. So before we go into the individual companies in the portfolio, I want to explain what do we look for in a company before we invest in it. And we look for certain characteristics in the target companies that we invest in. And, industry leadership position, I think is really important. So you want companies that have somewhat of leading positions. Doesn't have to be the number one, or a disruptor where they're disrupting incumbents with better technology or a better product or service. We like founder-led businesses. Founder-led businesses, management board with large shareholding, it really aligns their interest with us. And I think over the years, founder-led businesses outperform other companies. We look for profitable companies. We want a business that's growing both top line and bottom line. And I think it's really important. We don't invest in sort of loss-making speculative stocks. A strong balance sheet. We've learned over the last 12 months that that's once again important. Debt is becoming expensive. And so we want companies with a lot of cash or low debt levels as long as they generate free cash flow. And we're looking for businesses where there's very low market expectation. And what we mean by that is that if we believe that whatever the market is, the consensus is expecting a company to earn, if we believe that they're going to do better, or maybe they're not going to do as worse as what everyone thinks, this is the best opportunities to find, because that's when, if you're right, the share price goes up quite a lot. There are other attributes that we like: industry consolidation, strategic reviews, a new management and board, and we're trying to analyze near-term catalysts as well. So we want a reason for investors to buy the stock so the share price goes up over time. Now, what's interesting is that these attributes over the last almost 5 years since I've been running these funds have led us to receiving takeover offers. And in fact, up until today or yesterday, 24 portfolio companies have received a takeover offer in the last 5 years. And that number is 25 as of today. I'm happy to announce that another company in our small cap income fund, Healthier, has received a takeover bid at 90% premium. So pretty exciting. And it shows that our fundamental analysis and the way our investment strategy works over time. So I'll talk about some companies in the portfolios that we really like. Some of them are in both portfolios, and obviously some are only one particular fund. So the first one is Symbio Group. It's probably one of our top holdings. It's a leading tier 1 telco software provider. It provides sort of 3 different services, as you can see on the right, to whether it's small businesses, government, large enterprise. Also has a phone number, wholesale business. The best way to kind of explain Symbio is that, when you order your Uber and you're calling the driver, or the driver is calling you, there's a phone number that appears on your phone. That phone number and that service is supplied by Symbio. When you logged into this Zoom call, you also had an option to call a phone number. That phone number is provided by Symbio. So it just gives you an idea. They have very large client base. Now it's a founder-led business. The managing director owns 8.5%. We really like that. 75% of their gross margins are recurring. So again, we like businesses with recurring revenue, high switching costs. So you kind of know what's the revenue going to look like over the next 12 months. Strong balance sheet. This company has 35 mil of net cash, which, just to give you an idea, is almost 20% of the current market cap. It pays a dividend, good cash flow generation, and they can self-fund their growth. It is expanding to some Asian countries, which gives them some really long runway of potential upside. Now, what's interesting is that it's currently under a takeover offer from another listed telco called Superloop. The offer is at $3, and there's a due diligence period until mid-September. And now, we believe that, our valuation of Symbio is over $3, but we believe it's a really good offer because it's half cash, half scrip. So we can take some money off the table. We can take shares in the combined group, which I think will go up in value over time. Whether the bid goes ahead or not, we don't know. But even if it didn't, I think Symbio has a really good runway of growth. It's a good business. It's a fair valuation, as you can see, EV to EBITDA 5 times at the moment. So we will watch and see how this plays out. But this is just another example of ticking all the boxes and getting a takeover for a business that the market was ignoring. The next one is Viva Leisure. So they're an operator and owner of fitness and gyms around Australia and New Zealand. Again, founder-led business. The managing director owns 24%. They've got about 346 locations. 171 of those they own, and the rest are franchisees. They're probably I think they're the second largest group in Australia. Obviously they had a bit of a tough time in COVID, as you can imagine, but they finally came out of it. And FY23 was what I would call a COVID-free year. And they really showed, as you can see, revenue growth and EBITDA growth. They generated 12 mil of free cash this year, and next year we think it will be 15 mil of free cash. Strong balance sheet, not a lot of debt. It's a really cottage industry. There's about 6,000 clubs. They can continue to consolidate and open new greenfield locations as well. And what we like about Viva is a tech-focused operating model. They have dashboards for every single club on a daily basis, and they monitor. And if one club in a specific location underperforms, they can try and put changes to improve that. Everything is self-serve, from signing up through an app to actually entering the gym by tapping your phone. And they're launching a Viva Pay, where the payments will go through their system, and they're actually going to click the ticket on that, and it's another revenue line for them. We believe that even in a tougher economic environment, as we're sort of going through, $15 per week is kind of non-discretionary. We think it's quite resilient, and it has shown to be so far. And I think people will cut back on maybe buying clothes or going out to restaurants than canceling the gym membership. So trading on an EV to EBITDA of 4 times, a free cash flow multiple less than 10 times, we think it's really attractive and cheap. And I think catalyst will be FY24 guidance at the AGM, maybe further acquisitions, and launching that Viva Pay, which should make them more money. The next stock is a company in the travel industry. It's called Hello World Travel. Having come back from a trip overseas, I can reassure you that the travel industry is absolutely booming, and it's not about to stop anytime soon, regardless of the macroeconomic environment. I'm sure all of you on the call right now have got some sort of a holiday booked for the next few months. This is a $500 million market cap business. As I said, there's a really attractive macro tailwinds, an industry dynamics right now from demand from both local and international travel. It's recovering rapidly. But as you can see on that bottom right-hand side, overseas arrivals and departures, we're still not back to those pre-COVID highs. So there's still upside from here. And on top of that, we've got the resumption of Chinese tourism and cruise sales, which is really good. And most of the customer demographic of Hello World is sort of the over 55s. And I think they are more resilient to an economic downturn, and they're going to keep going on holidays and cruises, especially after last year where they were a bit concerned with COVID. I think this year and next, there's a bit of a travel revenge spend that will keep going on. Again, founder-led business, managing director owns 26%. They're in a massive upgrade cycle. So in FY23, they started from 24 mil EBITDA guidance to upgrading it 3 times to 44. They're given guidance of about $70 million of EBITDA for FY24. And we think they will probably upgrade again. Strong balance sheet. So just to give you an idea, $35 million, they own some shares in another listed company called Corporate Travel, and they've got 75 mil of net cash. So again, 20 to 25% of the current market cap is in net cash. So we think possible capital management or more acquisitions like they've done last year. Very profitable and dividend paying, trading on about an EV to EBITDA of 5.5 times for FY24. Just to give you an idea, Flight Centre, Webjet, they're kind of on more than 8 times. So we think there's a good 50% upside here. And the catalyst to drive that are the October Q1 update, which they'll give at the AGM, maybe capital management, acquisitions, which I think those things will drive the share price to our valuation. The next one is another really exciting company, and this is what I would call a disruptor in an industry. So SmartPay, I've spoken about this company before. They're 360 mil market cap. They're the second largest non-bank merchant terminal provider in Australia and New Zealand. They compete with Tyro and they compete with the banks. Most likely, if you go to a local cafe, store, even a few Domino pizza outlets, you'll be tapping your phone or your card on a SmartPay terminal. And they've got, the market in Australia is really dominated by the large banks. There's like 1 million terminals out there. They're probably targeting the small to medium size end of the market, which is worth about 250,000 terminals. They've got 15,000 terminals in Australia. The Australian model is an acquiring model, which means they just clip, 1.5% on every transaction. Now, they also have a very, very significant position in the New Zealand market, about a 20% market share. They've got double the fleet as in Australia, 31,000 in New Zealand. The New Zealand model is different, but I'll talk about that soon, why it's getting really exciting. But they just get a flat $60 a month rental fee. So just to give you an idea, the Australian fleet of 15,000 terminals will make them 60 mil of revenue this year. And the double the fleet in New Zealand will only make them 15 mil of revenue. But that's about to change. And I'll explain why. So FY23 inflection point has reached, which means they not just reaching scale, they're actually starting to generate free cash. They're in a net cash positions, which means they can self-fund this growth of new terminals. Obviously, they're a beneficiary of tourism and the borders reopening last year. And as I've shown with Hello World, there's still a lot of inbound tourism to come into Australia. In tougher times, I think the average ticket value, or the average spend per transaction is $36. So I think, these are sort of low ticket value merchants, which means they'll probably be more resilient to an economic downturn. The managing director has got skin in the game, which we like. And what we really are excited about is this New Zealand division transition to an acquiring model. So just like in Australia, SmartPay has recently announced that they're going to become an acquiring business, which means that instead of charging a flat rental fee per month, they're going to clip a ticket on each transaction. So if you can just look at what they're making for the fleet in Australia, there's $120 million of revenue and $60 million of EBITDA to be had if the entire New Zealand fleet were to switch to the acquiring model. Now, obviously, that will take time, but they already own those customers. They just need to convince them to change to the new model, which I think is quite attractive for a merchant for various reasons. And so we think that, in 2026, this is a business that could be doing 250 mil of revenue, 70 mil of EBITDA, and this could be a $1 billion market cap quite easily. And one more thing, it is an inflation beneficiary. So as you can imagine, if he takes a percentage on his transaction, if the if the price of items go up, they just make more money naturally. So we'll look forward to some updates from the company. They provide quarterly updates, and also when they launch that New Zealand acquiring model, which is really exciting going forward. The next two stocks which I'll talk about are what we think is the best exposure to that EV, electric vehicle revolution that's happening in Australia and around the world. You know, a lot of investors are buying speculative, loss-making lithium stocks and so on. Well, we like to buy really profitable businesses that have that exposure as well, and I'll explain why. So the first one is Flick Partners. It's a $770 million market cap business. It's one of the leading providers of fleet management for government and large corporates, and it also provides innovative lease services to employees as well. It's got $2 billion of asset under management. It is a big electric vehicle beneficiary through government subsidies and higher car values of EVs. So if you can think about it, there's a lot of tax breaks and incentives for people to buy electric vehicles at the moment. And also the price of electric vehicles are much higher than petrol engine cars. We're looking at a 30% premium at the moment. And obviously this company charges somewhat of a percentage of the value of the cars under their fleet. So, you know, if their customers, are taking up more electric vehicles, they make more money. Now we're seeing really strong business momentum. The last third quarter update, new business is up 26%. And more importantly, electric vehicles represented almost 50% of all new business quotes. Now, this is really important. And I think that will drive demand over the next few years. They have a really strong balance sheet, net cash, which they can support M&A. We know they're actively looking for M&A, which means it will be super accretive when they buy something because they can take on debt. They don't have to raise money. It's trading on a really attractive valuation, 9.5 times PE versus some of their listed peers trading anywhere between 12 to 18 times. There's been a bit of rumors in the papers recently about Flick Partners, a takeover target. So that's something to watch out. He did receive a takeover offer a few years ago from another listed company. So something to watch out. Now, even more exciting is their capital management policy at the moment. As you can see on the right-hand side, they're doing one of the most significant buyback programs that an ASX listed company in Australia is probably ever done. You know, they're buying back essentially 70% of their net profit is because they don't have any franking credits. They're utilizing it to buy back their own shares. Just to give you an example, since this started over the last 18 to 24 months, they spent $170 million buying back their own shares. So 24% of their share capital will be cancelled by next month, which, as you can see, is significant. So even with the price of used cars coming back down, which does impact their profit a little bit, in the next 12 months, their earnings per share will continue to grow because of this buyback. And then we think they'll do this buyback up until FY26 when they start generating franking credits and then pay dividends. So I think this is a really good story, both on that EV thematic and a good growth story as well. The second stock here in terms of that EV thematic is a company called IPD Group. The code is IPG. This is almost a 400 mil market cap business. We actually first started buying this company when it first listed at 100 mil market cap or $1 a share. And IPD Group is essentially an electrical wholesaler with an end-to-end EV charging solutions offering. So they provide consultancy, hardware, software, installation and commissioning of electric vehicle charging stations. That opportunity alone is a $5 billion opportunity at the moment in Australia. And as you can imagine, because they're an electrical wholesaler, there's a lot of demand from data centers, and that industry as well, which is it's a high growth industry with the artificial intelligence and everything that's going on at the moment. Now, electric vehicle sales as of the first quarter of 2023 were about 7.5% of all new cars purchased. That's up from 4.5% last year. And I think as of July this year, I've seen numbers that's already in the double-digit figures, and it's only going to go up. In the UK, it's 30%. In some of the northern parts of Europe, it's 70% of all new cars are electric vehicles. We know that's the future. There's currently almost 5,000 public EV chargers, but there's only about 470 fast chargers. We're going to require 20 times more public chargers by 2030 compared to today. The Australian EV Council estimates that 1 million electric vehicles are needed on the road by 2027 to reach that net zero target by 2050. So that really equates to 12 times increase from last year's level, or something like 2.8 million charges required. This will drive many, many years of growth for companies like IPD Group. And as you can see, this is not some speculative EV story. This is a company generating, as of FY23, $230 million of revenue, $28 million of EBITDA. It's got 20 mil of net cash on the balance sheet. The multiple is sort of 17.5 times excluding cash. But really, this is a strong growth story, growing at 45% profit CAGR over the last 4 years. And I think they're just going to continue to deliver. Again, a founder-led business. The management and board owns almost 40% of the company. So we know that they're aligned with us. And I think the catalyst for this talk to take it further, strategic acquisitions, FY24 guidance at the AGM. And also they've recently won part of the $100 million charging station for NRMA. And if they can win more of that contract over time, it's just another validation of this great growth story. The next company is going into the life insurance industry, Clearview Wealth. This is a company that we've been invested for the last couple of years. It's a $320 million market cap. They're one of the leading mid-tier life insurance providers in Australia. They've got about 4% market share of force premiums, but they're taking 9% share of all new business. So as you can imagine, if they over the next few years, as they continue to take 9% share, eventually their in-force premium share will go up from 4% to 9%. They really simplified their business model over the last 2 years. They divested and sold their wealth management business into another separate listed company, which they own a percentage of. And now they're really just a pure play life insurance exposure. We thought they were going to get taken over 12 months ago, but actually now they're probably a more attractive takeover target than it was 12 months ago for the reason of the industry is growing, the profitability is growing. In fact, I'll talk about their FY26 goals, which are extremely bullish. And I think that they're more likely to receive a takeover now than they were 12 months ago. The industry fundamentals have improved. And not only they're taking market share and they're improving their margin, but they are going to take on more underwriting risk now that they're starting to generate even more cash. Now, more underwriting risk means they're going to win more business, which means their profits will go up even more. Really profitable momentum. So they actually upgraded the FY23 net profit after tax through the year, and they beat the top end of the guidance, which came in at $36 million last year, 41% growth. They have a really strong balance sheet. So 71 cents asset backed. So if you were to liquidate this company tomorrow, you'll get 71 cents. The current share price is 55 cents. The embedded value of this business, including the franking credits that they have, is 91 cents. They've announced a full year dividend of 3 cents, fully franked. So it's a 5.5% fully franked yield, so really attractive on top of that growth. They are a beneficiary of rising interest rates. Every 1% rate rise adds a $2.3 million profit, which is quite material for them. Even though we probably reached the rate rise cycle, hiking cycle in Australia, probably reached the top here, but I don't think we're going to be cutting anytime soon. So, they are going to benefit from that. A really attractive valuation, 10 times PE for a business growing at 20%. We think it's really attractive, and we think the share price will continue to go higher. They have a very, very bullish FY26 aspirational target. As you can see, they're targeting new business market share of 12 to 14% compared to 9%, gross premiums of 400 mil, and then they're looking for their life insurance underlying profit margin at 11 to 13 and a good dividend policy. So based on our analysis of that could mean a 7 cents earnings per share in FY26 and a 4-cent fully franked dividend. I can assure you, if that's the case, the stock price is not going to be 55 cents. It's going to be 80 to 90 cents. And obviously, we'll track their progress to that aspirational target. Really exciting story, and I think the market is going to awake to it over the next few months. Finally, the last company I'll be talking about today is a company called Close the Loop Group. Really one of those ESG type stocks that actually makes a lot of money. They're a 220 mil market cap business. They're a global provider of waste recycling and packaging. They've got 260,000 global collection points. They've established a really strong moat around that, and they actually make money from collecting. So if you can think about, the industries of print cartridges, makeup, supermarkets, pet food, batteries, electronics, every company has an environmental footprint, and they have to do something about it. And whether it's recycling or whether it's refurbishing and repackaging, companies have to do something about it, and Close the Loop provides them that option. As you can see on the right-hand side, from collecting retail packaging or bags, that they can turn it with their process into other items that can be sold. For example, your makeup, for example, that gets recycled, gets turned into what's called a toner plus road asphalt, and that gets used when asphalt is being poured to make roads. And it actually has better longevity than your typical asphalt that's used. A big beneficiary of the ESG economy. They did a transformational acquisition last year of a US business called ISP Tech. That was 100% plus earnings per share accretive deal. So now they have a really strong US focus, and they're going to take that business with their customers, as you can imagine, in the electronics industry, companies like Hewlett Packard and Dell and so on, and take that offering that they have of refurbishing laptops and printers and so on into Europe as well, and they can double that business. So it's really exciting growth prospects. They're guiding for FY24 guidance of revenue greater than 200 mil, EBITDA greater than $43 million, and NPAT greater than $24 million. They generate really strong cash. They have not a lot of debt. We think that they're going to pay off most of that debt by the end of next year. Trading on about a 10 times PE, an EV to EBITDA of 6 times. We think it's worth at least 40% more than the current valuation. And the key catalyst here will be the guidance, which they'll give at the AGM on FY24. And they hopefully firm those numbers up. And the progress on that ISP acquisition, the integration of it, and their expansion into Europe. I think it's a really good story. And it probably ticks a lot of the boxes for those institutional investors who need to invest in companies that tick all the ESG boxes. And this one definitely ticks all of them. And then just finishing off, This talks about the returns for the two funds that I manage. And I think it's really good to talk about this for a moment and see, as you can imagine, as you can see, the all cap portfolios and the small cap income portfolios, they had a really good first 3 years, extremely strong performance. We were averaging about 30% per annum, even through the COVID period, but we were down a lot. We recovered strongly. Last year was a tough year. There's no doubt about it. The markets were down as well. We were down. The all cap was down a lot more because it does have more exposure to growth companies. The small cap income fund wasn't down as much, in line with the market, as some of the companies are, I guess, pay dividends, so they were sold off less. The good news is that, and as we were telling investors at the time, is that the market will bounce back and we'll be back to strong performance. And as you can see, as of the end of August, calendar year to date, the all cap portfolios are up almost 24%. At the time of the webinar back in early April, when I was doing this, the fund was flat. And I predicted a strong performance this year, and we're on track. The small cap income fund hasn't performed as strongly. It doesn't have that exposure to some of those growth companies that were getting absolutely smashed last year. But we think it's about to turn, and we think it's going to perform strongly towards the end of the year and into next year as that sentiment shifts. And as I've shown in the early part of the presentation, the gap between small cap valuations to larger peers will close. Just to give you an idea, over the last almost 5 years since I took over these two funds, all cap has averaged 15.5% net return on an annualized basis. And even the small cap income fund, which hasn't bounced back yet, still averaging over 11% net return per annum. And we want to remind investors that it's important to stay invested because the compounding effect of such returns are significant. $1 million invested in each one of these funds over a 10-year period, if we were to continue to deliver those annual returns of 11% or higher, will grow to over $4 million. So it's important to remain invested over the long term. And once in a while, you're going to have a bad year, but as we're showing, we're able to recover and continue strong performance. So thank you very much. And I'll now pass over to Darren, and we'll take any questions that you have.
Thanks, Ron. I might just ask you if you could just mute your microphone there as well. Otherwise, we're going to get a bit of echoing happening. There we go. Okay, so hopefully everyone can hear me, and really enjoyed that webinar and the presentation, specifically the segments around a number of the companies that we own across the portfolio. One thing that we're starting to notice quite significantly in our conversations with both investors and potential investors is that the focus is coming back much more towards fundamentals. The one thing I actually even noticed at a personal level, the first time in probably about 3 years, every morning when I wake up, the first thing I do, I grab my phone and I have a look and see what's happened across markets through the night. And literally on Tuesday this week was the first time in 3 years that I did not actually do that. Waited till I got to the office and then started looking at markets and reading through all the news reports. So if this is what's happening at a personal level, we're starting to see that happen much more broadly across the markets, which to us is a very good indication that people are coming back to work towards looking at fundamentals across individual investment assets and moving away from the conversation around the broader macro events. And certainly for us as stock pickers, we think that that is a driver or a key driver to generating returns for us. So we're quite excited about that shift. Before I head across to questions, and I can see they're coming through thick and fast at the moment, I might just reiterate on a point that Ron brought up towards the back end of his conversation. It's really important to look at investing across a longer term time frame, and this really hit home for me when we were talking, and probably some of you were listening in on that conversation a couple of weeks ago on our global equity portfolio webinar. With investing, the effects of being invested over a long period of time with a good manager who has an ability to generate a good, strong return over a long period of time is immense. And specifically over the global equity portfolio where we were running the numbers, $1 million invested in that portfolio at the start, and it's compounded across 13% or at 13% across the time frame, gives you today $4.5 million for your portfolio. And that's going through periods which are inflation based. The period of the Trump presidency in the US, where there was a lot of volatility in markets, COVID, and even going back towards the banking crisis in Europe. So certainly is quite important to focus on that. So with that, I might actually stop running through some of my points and really get onto the questions that people are asking us. I know there's a few in there that talk about maybe the macro conversation. I might touch on the first one there on. We really don't need to spend a long time on it, because I'd say as good as we are at picking stocks, maybe our macro views are not as good, but certainly I'll touch on the first one here. China and a little bit of the crisis there. How do you feel that their potential for issues around their development debt and their property debt impacts markets going forwards, and in particular the Aussie equity market?
Yeah, thanks, Darren. Yeah, look, we're terrible at predicting macro and markets. Look, personally, markets haven't blipped. I mean, this is kind of like one of those known knowns, and it's a known risk. I think it's really contained to China. I think the Chinese government will handle it like they do everything behind the scenes, and somehow they'll all get rescued or whatever. But at the end of the day, what's important for Australian equity markets is the US economy and the US stock market. That's what's going to drive the Aussie market. And that's where we need to look at. And if you look over at the US, the US economy is still holding up. They've reached the end of the rate hiking cycle, in our view. Inflation has come off a cliff, and it's back to the sort of almost at the top end of the long-term range. And I think that's really the key that we need to focus on. And, you know, that there's going to be issues. This really reminds me of the pigs back in, you know, after the GFC. You know, Spain was about to go bankrupt, Greece, Portugal. You know, who cares? The world moved on, and it's not going to affect us. What matters is really the US, and I think the US is going well.
Thanks, Ron. We have a question about the most favorite question that we have across all the years from our webinars. People are asking a little bit about EML. We haven't spoken about it in today's presentation. Do you still own it? And what are your thoughts on what's happening within the company?
Yeah, sure. So yeah, we own EML, and we actually have made a significant amount of money on it this year. As we explained to investors and everyone, we did cash out last year. EML has been a very profitable trade for us over the years, although we gave some of those profits back last year. And once the board and management changed, we took a position in at 60 cents. And I think the last price today was $1.18. So we've made a lot of money here. I think it's a good turnaround story. The new board has really simplified the business, taken cost out. They've exceeded guidance at their results. I think they're about to sell off some of their loss-making divisions, and maybe even sell the whole thing. And I wouldn't be surprised to see the company and the stock price continue to improve as that sentiment changes with the new management. And once they put behind them all those issues with that problematic PFS business in Europe and the UK. And I think we'll get some good news over the next few months. They're going to put out guidance and then a strategy outlook no later than their AGM in November. So yeah, we own it. We've made a lot of money again, and we have taken some profits, and we still own a position.
Thanks, Ron. Just a question here around your portfolio. I know we've spoken a lot about stocks that we like and probably stocks that have done fairly well in the portfolio. Is there anything over the last 6-12 months that you think you've gotten wrong, and sort of the reasoning behind that, and what have you learned out of it?
Yeah, sure. Look, we tend to get things wrong all the time, but you know, that's why we hold a portfolio of somewhere around 30 stocks in each fund, and we're diversified, and so you know, we're going to get a handful of stocks wrong every year, but as long as the rest we get right, then that's going to continue to deliver us those returns that we have over the last few years. This year, there has been a couple of stocks that have been in the small cap income fund that didn't really go our way. One stock is PPE. They're a labor hire business. If you actually looked at their results, it looks unbelievably amazing. Strong cash, you know, the 8% fully franked dividend, trading on a PE multiple of 6 times. But the market is concerned about next year, obviously. And next year, obviously, the economy is a bit tougher, so their profits might go down by 10%. So the market has sold them off. So that hasn't worked out for us. We still own it in a small cap income fund. I think it will recover, or someone will buy it. And in the meantime, we get paid 8% yield. And the other one that we got wrong, and we did exit because we lost trust in management, is a company called Solva, which used to be called Money3. They provide, they lend money for used cars and new cars in Australia and New Zealand. They did a large downgrade a month or two ago. We were quite disappointed. Back in February, when we spoke to the management team, they indicated to us, to the market, that next year's profit will be maintained at least flat to this year, but the downgrade shown that they're not really across the business, their funding costs, and so you know, we exited that position at a loss, and we moved on. So those are a couple that we got wrong, and it was more in the small cap income fund, unfortunately.
Ron, a few questions about one of the stocks you mentioned briefly earlier, which obviously was subject of a takeover offer this morning. Healthia, just a little bit of your thoughts around what's happening in there and the announcement earlier this morning.
Yeah, so the Healthia is in the small cap income fund, so finally some good news. They are an allied health, so physios, podiatrists, and so on, business in Australia. They've got way too much debt, unfortunately, and they obviously were impacted with COVID and disruptions to that. So that business got a $1.80 all cash offer from PEP, private equity. It's pretty much a done deal. The offer values them at 8 times EV to EBITDA. I think it's a good price, especially considering the debt levels. I highly doubt there'll be a competing offer considering the valuation. So I think it's pretty much done, and we're happy to move on. And we actually ended up making money here, although we were down quite a bit up until now. But this just shows you that patience pays off, and even companies that underperform, if they have a good underlying fundamental business model, and I think healthcare is a good business, and eventually if the market won't price them, then someone in the private market will.
Ron, I can see that I've got a number of questions here just around the structures and investing in the portfolio. So I might just quickly run through just the terms of the actual investment. There are actually 2 ways that you can invest into these portfolios. One is through an individually managed account. The minimum investment there is north of $500,000. You are also able to invest in it at a minimum of $100,000 through our unit trust structure, which is probably one of the more common investment structures in Australia. That attracts a management fee of 1.25% per annum, plus a performance fee of 20% above a hurdle, which is the RBA cash rate plus 2.5%. There's a buy-sell spread on that of 25 basis points on either side. Applications on that are available monthly, and we are able to send you out either a print format information memorandum and application form, or you're able to sign up for that electronically via our online application portal, which is to be found on our website. You are also able to redeem on the portfolio monthly with 30 days notice. And then the fund will distribute, or both funds intend to distribute on a semi-annual basis, although certainly the distribution is intended to be through that 30 June period as well. So that's a little bit around the terms. I also just wanted to point out that if you've enjoyed today's webinar, we publish a newsletter on a weekly basis. In fact, 4 o'clock today is the normal time for that to go out. We have also started to put our articles out on a more regular basis through the course of the week. So if you'd like to follow those, certainly by all means sign up to either one of our social media pages on Facebook, LinkedIn, or Twitter to get alerts around when those articles are sent out, or you can just simply hop onto the website and have a look for when those happen. In addition, towards the end of the year, we'll probably run our webinar series again, but this time around we also intend to get out there and do a number of face-to-face meetings throughout the country. So we'll be running presentations in the first week of December, and look out for information around that. I'm just going to look through the rest of the questions here to see if I've missed anything. There are a few that are still required to be answered, and I'll certainly get those out to people. One last question. I'm not sure if you've got that many thoughts around it, but question around WiseTech. I don't know if you have thoughts there. Do you have an opinion, and what are your thoughts around improvements within the company?
WiseTech WTC. We don't own that one. Look, it's been an amazing an amazing stock since they listed at a couple of dollars. Great growth story. Valuation is just too full, and for us, it's trading on I think 70 times EBITDA. So it's a bit too rich for us. We like to buy on 5 and 10 times EBITDA, not 70 times. But it's a good story. You can't fault Richard White and the business that he's built. And yeah, if you own it, maybe you just keep holding it. But it's not one that we would buy anywhere close to these valuations.
Ron, thank you so much for that. With that, I might just close off with just a quick thought. Certainly, the one thing that we've looked at across investing, going through a tougher year in 2022, we know that the managers we work with tend to generate a longer term average set of returns. And certainly, when we look at Ron's portfolios on the all cap, we know over a long period of time he's been able to generate very close to that 15% annualized return. On the small cap income portfolio, a little bit less, but around about 11.5% annualized return. What we've seen over the last period of time is that those return numbers over shorter periods have been significantly lower than that. And what that gives you is a really good opportunity to come into these portfolios and start investing and taking advantage of depressed share prices. Certainly, the fact that small caps, and to a lesser degree the all cap sector as well, are significantly under pressure versus their larger cap peers in comparison to the historical timeframes, says to us there is a phenomenal opportunity here. To us, we would be looking at this, and while certainly this is not intended to us from us to be advice to you, our thought process for our own portfolios is that we think there are phenomenal opportunities available in the space. And certainly if you have funds available to be looking at investing into the equity market at the moment, we think this is a phenomenal opportunity and a really good time to be looking at investing in it. And if you do share the same sentiment as us, both Ben, Sid, and myself, would be very keen to have a conversation with you. So please give us a call. Other than that, we would like to thank you for your time today and for joining us. As always, we look forward to these webinar series and enjoy holding them. And until the end of the year, we'll speak to you again then. Thank you so much.